we've got just about everyone now. So welcome to the Athena Labs Twitter Spaces. Today we are going to be discussing the recent integration between Athena, Maker, and Morpho. By way of introduction, my name is Connor. I lead research at Athena Labs. And yeah, I guess just to give a quick recap on that recent integration. So Maker recently deployed a 100 million DAI direct deposit module to Spark's USDE DAI markets on Morpho Blue. And within 6 hours, basically, that DAI liquidity was almost fully borrowed, projecting to earn Maker about 50 million DAI in annual revenue from that 100 million deployment. And then I guess based on that strong borrowing demand from Athena holders and the revenue opportunity, MakerDAO, I guess, proposed another upsize in the allocation to about 600 million DAI into Morpho again in the same markets, with the possibility of that to go up to 1 billion. So the space today is basically discussing that, going into a bit of detail, I guess, on the risks of that and how we're thinking about the integration in general. But we've got, basically Guy from Athena here. We've got Rune from Maker and Paul from Morpho. So yeah, looking forward to digging into it with you guys. So I guess we can start with Rune. Probably makes the most sense to start with. Rune, welcome to the Spaces. Thanks for joining. I guess, Rune, can you speak to the thought process behind the proposal especially to increase the DAI caps now for USDE collateral, and also maybe how that fits into the end game plan?
Hey, yeah, thanks for hosting the space, and thanks for everyone coming to listen in. Yeah, so the push to increase, or begin allocating into Athena, as well as actually other avenues for the basis trade exposure. So the kind of exposure that Athena does, perps yield, we also call it. So that basically happened in this process leading up to the launch of Endgame, which is the big transformation that Maker is about to undergo with new brand and new tokens and sub-DAOs and all of this stuff that's coming over the summer. And then basically leading up to that, I made a proposal to, first of all, basically clear the obstacles to rapidly onboarding, specifically the perp yield, and then also some other changes, including stuff related to the burn engine, and basically increasing the rate at which the protocol uses surplus cash to build up its MPI liquidity. And so this is really, so in both cases, it's really that I think the current bull market has created some very unique opportunities or distortions generally in the crypto markets compared to TradFi markets, right? Where what's happening is, and I think a lot of people are discussing this kind of this dynamic where what's happening is crypto itself is going into this, it looks like, and who knows, maybe it's already over now. Maybe now the bubble's over, or maybe it will continue going. I guess a lot of people think it will continue to go even higher than what it's been so far. And people expect this irrational, full retard bubble that we're used to seeing in crypto. And as a result, you have you got tons of people buying meme coins and then going crazy long leveraging on ETH and Bitcoin, right? And that's where these super high funding rates come from. But because it's crypto related, then it's just not these interest rates that are produced out of the kind of the expectation of an irrational bubble. They're just not well taken advantage of by the kinds of capital pools that would normally do that. So that's ultimately, I think, that's what I would say is the really unique opportunity that exists right now with perp yields, right? And that's why I ultimately made a proposal to make this possible. Now, why does this matter to us? Because in the end, what all this means is just that right now there's there's a kind of gap in the market where it's possible for, well, basically like sort of large scale protocols like Maker and other large scale DeFi protocols can earn really like sort of like yields are basically, they don't really make sense in a sense, right? Like they shouldn't exist because they should be arbitraged out by TradFi, but it's not happening temporarily because we're just in this in-between state where crypto is like too focused on the crazy high, the bubble that they expect to come, and TradFi is just like too confused by, it's too new. So it's a very unique moment where you can actually do this at a large scale. And being able to generate a significant amount of cash returns, as well as then also buying a lot of MKR liquidity, right? Using those cash returns to build up a massive liquidity buffer for MKR, which is kind of the two main changes that I proposed that led up to this integration. That fits extremely well into the entire launch of Endgame basically because of the launch of the new tokens, right? And the subDAOs. So when we launch the new token, we're going to redenominate MKR 1 to 24,000. So the goal is to like make the token a lot more accessible to retail, to normal people, to people just getting into crypto. Having like a super expensive token is kind of off-putting, sort of signals a kind of elitism or something, right? That is kind of the vibe Maker used to go for, but now we basically want the opposite. We want to make something that's very, very approachable and really want to build resilience through scale, right? So that we can have a lot of participants, can have a very large connected system, and then through that build up the really large scale, and then the ability for the system to provide massive stability. I mean, highly scaled stability. But when you do this kind of redenomination, it's just really useful to have as much liquidity as you possibly can available in the token, right? So the way the Maker burn engine currently works is it uses profits from the system, so it uses surplus cash to accumulate liquidity for MKR that it just trades and provides liquidity for on UniV2. And this then helps make MKR more liquid. So anyone can go and trade it on chain with Uniswap. And also in the event of like a major sell-off, there's a lot of captive liquidity, as I like to call it, right? There's a lot of protocol-owned liquidity that's just sitting there and just buying the token. So it makes it less volatile. It makes it so that there is actually buying pressure even in major market sell-offs. And then when you do a redenomination, you're like introducing a completely new token, right? Out of like, on one hand, it's a brand new token with like a completely new price, but on the other hand, it has all the momentum and all the mind share and all the buildup of the launch of Maker and Endgame. So if we have a huge amount of protocol-owned liquidity, it's just really gonna reduce the risk of this launch, right? Because it means that we can move all of that protocol liquidity directly to the new token, right? So it's born with as much protocol-owned liquidity as possible, and as a result, isn't gonna be like crazy volatile in its initial moments. Large capital buffers, right? So basically, large amounts of cash, and that's always a good thing. Cash is always good. Every protocol, every business wants to make more cash, of course, but often it's like actually in sort of a growth situation, it's not necessarily that interesting either, because it's not always you have something to do with the cash. But the upcoming launch of the subDAOs really provides Maker with this like really, really unique opportunity where there is a huge potential to get a lot of things done with cash, because we can use this cash as the capital buffers for the subDAOs. And it was actually kind of like a sort of a missing link in the launch up until this point, that the goal is that when the sub-DAOs launch, they should very quickly be able to take a lot of autonomous decisions and take a lot of risk and do a lot of experiments. But the problem is, in order to do that, what they need is they need some kind of cash buffer to absorb that risk. So without a major cash buffer, the launch of the sub-DAOs just gets, either it gets less exciting because they can't do as much, or it gets more risky because they'll be allowed to take more risk with less buffers in place, right? So all of this has come together to basically mean that right now what we can do is we can take this massive opportunity to generate yield with basically with the basis trade with the perpetual swap yields that are available, and we can use that to build up cash buffers that can be transferred to the sub-DAOs when they launch. We can use it to build up the liquidity buffer for MKR, which means that the launch of the new token, the new governance token, will be much smoother and much more stable. And then it actually feeds also just really, it's just an amazing tool so far. But of course, that's like in general, in the long term, this whole ability to tap into this kind of like basically using sort of a trading strategy as collateral, it's just really innovative. I think ultimately, once you understand how it works and you can sort of peel back the layers of complexity, so it's not just like a black box, but you actually understand how the different components work and why it's safe to do it. Then it's just an incredibly powerful tool. It's perfectly suited for sub-DAO use, right? So in the future, when sub-DAOs launch from Maker, there'll be many different sub-DAOs. They'll all focus on different businesses and specialize in different things. And they'll trade in different ways. They'll allocate capital. They'll borrow money from Maker, and then they'll allocate that into collateral. And then the goal is that they need to be able to innovate as much as possible to push the risk-adjusted reward as high as they possibly can, right? And having access to something like the basis trade, and just more generally these types of like this type of approach to generating a yield and to allocate collateral, it's just I think it's like it's a really powerful tool, and it fits, as I said, it fits really uniquely with how the sub-DAOs can work because they can have this autonomy. Again, the one thing that's missing though is a capital buffer to do it, right? So that's kind of the time sensitivity where it makes sense to move really fast to grab the opportunity and build up the capital buffers. And then of course, I guess now I've listed a whole bunch of different reasons and a couple, like many different sort of chains of thought, right? But I think the way it all ties together is that Maker has originally, sort of the first major transformation of Maker was to innovate on the supply side, right? And to get into real assets, because we realized this was the only way to scale up something to be pegged to $1, right? So basically, real assets were like they became the highest yielding way, the best way to generate a yield, or even just maintain stability in the absence of yield for a dollar peg stablecoin, because it's easily scalable collateral assets. And then with Endgame, what we've been focusing on for several years is like how to build out sub-DAOs, how to rethink user acquisition, how to create a streamlined brand. So basically innovating on the demand side, how to get more people to hold the stablecoin. Basically with the basic thinking that all of this, like on the demand side, all of this demand that's going to be generated, that's probably just going to get dumped into RWAs because that's just the scalable method we came up with. But where it gets really exciting is when you combine the two parts, right? And where you have the sub-DAOs, not just through the tokens, through like sort of the having front ends and doing marketing and having communities and brands and all that, not just have them generate demand that way, but also have them actually harness these kind of more powerful tools on the supply side. So more flexible, more innovative, more complex ways to generate yield. And then basically taking advantage of the fact that take advantage of the fact that the sub-DAOs can specialize in these areas, right? So Spark is, for instance, a sub-DAO that definitely is focusing on the supply side and the allocation of this kind of stuff, right? Which is why that the Morpho Vault is controlled by Spark, and why I mean, all of these mechanisms, like the Spark protocol and all of these types of DeFi innovations, the goal is they will all go to the Spark community, because then people who farm SBK tokens, they can specialize in governing exactly this kind of stuff. And then that also makes it go full circle, because the fact then that Spark DAO has this kind of purpose, that it really has a community that's specialized in this, that's able to do that's obviously that gives it a source of unique value that then translates into interest in people farming the token in the first place. So you kind of manage to then combine the demand side and the supply side, right? So what we're doing on the supply side not only generates yield, but it also generates sort of business models that can then be packaged into tokens that's going to help grow things on the demand side. Yeah, I'll stop there, but that's how I would put it in the really big picture, like how it all ties together and why it ultimately like fits into why it makes sense to do this right now and prepare for in-game launch, which hopefully we can get done over the summer, right? And we can get momentum going for the entire industry, right? The whole space hopefully will. Hopefully the bubble continues, doesn't go completely bad, and then everyone benefits massively, right? And DeFi in particular can sort of get on top of this and be the ones to lead the charge on innovation, and even getting attention for people, right? So it becomes more than just meme coins.
Yeah, great, Rune. Thanks for that. Thanks for that overview, and definitely want to dig deeper into things like the extra flexibility the sub DAOs afford you guys, and the maker token backstop and things like that. I do want to give Paul from Morpho a quick chance, maybe to just talk about, I guess at a high level for Morpho, how you guys are thinking about the design of this integration with Athena and Maker, and then maybe also specifically how you're thinking about the risks as well, as regards to Morpho.
Yeah, sure. So first, thank you for having me in the space. And I guess the first thing to explain about Morpho is that it's a permissionless, immutable, and efficient lending protocol that completely externalizes like risk management to above layers. So like the protocol in itself has no notion of management. It's completely governance-less. It's completely immutable. And so you can think of it as Uniswap pools, but for lending markets, right? So each pool has one collateral asset, one loan asset, one risk tier, and one oracle. Same way on Uniswap, you have like two assets and a fee tier. Here it's like two assets and a risk tier in some way. And so this approach enables us to be like much more focused at just doing one thing, which is like lending and borrowing, and not caring about like risk management, UX, etc., because all of this is externalized from the protocol and will be rebuilt on top. And so the core protocol that we call Morpho Blue is like a singleton contract that's completely immutable and efficient. So now, as a lender, if you want to deposit into Morpho Blue, it's not that easy, right? Because if you have some USDC or some DAI or whatever, you have to select, okay, should I be lending into the pool backed by STEs, by BTC, by USDE? I have to make a risk decision, right? And obviously, like that's a major difference with like other protocols like Aave or Compound, where risk management is enshrined inside the protocol. So like, risk management decision and management of funds in general is done through governance, right? In Morpho Blue, the users have to do it. And obviously, that's a bit annoying for users. And so this is why we have a second protocol, which is a layer above Morpho Blue, which is called Metamorpho. And essentially the idea is that anyone can create vaults where you can provide like passive capital into it. And this capital is going to be, risk managed across the multiple Morpho Blue pool, right? So, we have a bunch of risk managers. Actually, like all the best risk managers in the space are building on top of Morpho. So you have like Gauntlet, Block Analytica, Protocol, Stakehouse, RE7, etc., that are essentially building vaults where people can deploy capital in a very passive way, the same way they would do on Aave or Compound. And then, Gauntlet is going to allocate it to 4 or 5 different markets that are, expressing a specific risk profile. And this way you could have like recreate the same liquidity and the same risk profile as what you would get on Aave or Compound, but with a more targeted risk profile, right? You don't get to subscribe to all the risk that you have in a monolithic platform. You just, subscribe to the risk that you want. And this sort of like unique architecture, enables us to, tackle much more different use cases. So first, the idea is that it's completely unmanaged and permissionless. So anyone can come in and deploy their own pools and their own risk management on top of it. And this is what allowed essentially, Spark and Maker to come in, deploy their own pools, and do their own risk management the same way they've been doing on Sparkland, and they don't have to trust the Morpho DAO in any way, right? To do this, the code is immutable, and we don't have any as Morpho DAO, we don't have any control about what's happening there. And so that's about like the protocol architecture. And so now, like, even if like Morpho Blue is like very unopinionated about what's happening on top of it, like each risk manager, each DAO, each pool that is being built on top can offer like very different risk appetites. So we have vaults like around like LRTs, LRCs, real world assets, crypto blue chips, and most recently the Spark Vault that is managed by Spark DAO. And that is allocating, obviously, DAI to USDE and SUSDE. And so what's interesting there is that, so what I really like about the architecture is that if you look at Maker Endgame, it's really about unbundling and externalizing complexity and pushing it to the sub-DAOs. And here you could see clearly that Maker Core, like even if like the endgame is not deployed yet, you kind of have this similar paradigm with like the D3M, where Maker Core just have to decide to deposit in the vault and trust the sub-DAO and the Spark sub-DAO, and then Spark is going to do like the risk management at the vault level, and like make sure you have the right oracle, the right liquidation loan to value, etc., etc. And so I guess coming back to your question, I think the main question that people often ask is like, why didn't like Spark do this in Sparkland directly? And so you have multiple answers to this question. Well, the first thing is that like you have limited flexibility with the current implementation of Sparkland when it comes to interest rates and having per collateral risk based on what you have as collateral. The interest rates is the same for every lender in the Sparkland or Aave or Compound protocol, right? So it's very hard to have like lenders being able to have different interest rates if they're taking different risks, because it's some kind of like one size fits all for everybody. The unique thing about Morpho Blue is that it's all segregated and then reaggregated, right? And so what this enables Spark to do is to have multiple pools with different risk profiles backed by USDE and SUSDE with different risk tiers. So I think they enabled the LLTV 94.5%, I think, then 91.5% and 86%. And then, you have much more flexibility in terms of risk. And then for each of them, you have a different interest rates, you have a different caps. And so that's like unparalleled level of like flexibility for borrowers. And depending on, their leverage appetites, or depending on, the collateral that they use, they'll have different interest rates. Right? And so DAI depositors can benefit, from interest rates that are risk adjusted. And that does not impact other DAI markets that are existing in the Morpho Blue protocol. Like, for example, Gauntlet has a DAI Vault. And in this DAI Vault, it's backed by completely, other things, like I think STEs and WBTC, if I'm not mistaken. And this Vault is like yielding at, 7 or 8%, right? So while, the Spark Vault is yielding like probably like 60, or I don't have the latest data. So like that's the very like unique and interesting approach about this, is that you can have risk adjusted yield, and you only sort of like take the risk that you want to, and you don't get to be fully exposed to like all the different risk parameters changes that you have in a monolithic platform. And just to give an idea, like we're speaking about hundreds of risk parameters in those like monolithic platforms. And so that's like the broad overview. But happy to get into like more details around oracles or around LTVs if you want, Connor. But yeah, of course, want to leave some room for Guy as well. I'm sure he has like a lot of things to say about this integration.
Yeah, thanks, Paul. And obviously, super interesting the approach Morpho's taken. And I might just kind of double click, I guess, on the risk specific to Morpho. It's obviously a unique approach, kind of externalizing risk management to DAOs and service providers. But I don't know if you can speak on, are there any risks, I guess, specific to Morpho here that you're thinking about that are kind of front of mind?
Oh yeah, sure. So Morpho has a smart contract risk, obviously. So we have 600 lines of code at the Morpho Blue level that have been audited multiple times with like all the best auditors in the space and through audit competitions. It's actually very simple. Like it fits into a Medium article, right? It's like a one pager with like all the code in it. We spent a lot of time thinking through like, it's essentially what we've done over the last years, like thinking through what is unnecessary to put in the core protocol. And we removed everything that was unnecessary. And we're thinking more of building landing in layers where, users decide to opt in for risk. If they want, extra features, then they'll, go through the interface that has like auto liquidation or liquidation protection mechanisms with whatever Dutch auctions or English auctions or whatever. So the idea about Morpho smart contract is that we wanted it to be like completely immutable. And as minimal as possible, just have essentially what's needed, which is the interface between lenders and borrowers, and have this in the most secure and the most efficient possible way. And then on top, you have the Metamorpho layer, which is 800 lines of code, which is essentially like a very simple aggregator that lets Spark and Gauntlet and others and Block Analytica manage the risk of the vault, create the risk of the vault, and reallocate capital to make sure the rates are stable and liquidity is amplified, etc. So that's like the main risk about Morpho. But there is no risk management component enshrined inside the core protocol itself. So when you come to borrow, it's very similar when you come to trade on the Uniswap pool. You have to be careful about the Uniswap code and the parameters. So in that case, that's the Morpho code and the assets. Are the assets trustworthy? Is the oracle trustworthy, and is the risk parameter reasonable? So when you're a borrower, you don't really care if the LTV is super high, but you have to care about the oracle. Is it Chainlink? Those kind of things.
Great, thanks, Paul. And I guess sticking with the topic of risk, Guy, I know you had a kind of tweet about warning users, I guess, of taking up too much leverage on USD, and obviously USD and SUSD kind of underpin this integration. So I guess I'll give you a chance to speak on any concerns of risks regarding leverage building up.
Yeah, sure. I might just open up with maybe starting with why I think this is actually interesting as an integration. So I think there's been some comments floating around sort of asking why couldn't people just do the trade themselves in terms of a basic cash and carry. And I think it's actually stuff like this where you're actually leveraging like the unique composability of DeFi with using a tokenized cash and carry that starts to actually make it more interesting than being able to do it yourself. So if you have an ability to take a tokenized version of that cash and carry and then put it on a money market and borrow funds at a lower interest rate than the asset is yielding, that actually starts to open up really interesting opportunities for you to get relatively safe post-leverage returns on the asset. So as a basic example, if you're assuming that SUSD is yielding, call it 20 to 30%, and you can borrow from DeFi at 10 to 15, that obviously opens up a pretty interesting spread for people to be able to lever up that position. Having said that, while it is obviously like one of the more unique and I think powerful like use cases of like DeFi and Athena's SUSD coming together, I do think that there are like some particular pieces around SUSD that people should just be at least considerate about when they're thinking about doing something with Morpho with SUSD. So one is just around the actual cooldown on the asset. So SUSD requires you to basically unstake and cool down for 7 days. What this means is that some users are not going to be willing to wait for 7 days when they're going to be wanting to get out of the asset for whatever reason. And as a result of that, you might actually see small discounts on SUSD as people are taking whatever liquidity they want, and someone else is going to be there to pick up that duration for some level of discount and a pickup in the yield. All of that is to say is that you can and you will see some small discounts in SUSD because of this duration piece. And it just needs to be considered by both users and I think actually the risk managers who are putting in place the parameters around these vaults. I think the other one to just consider is like more of a broader point, which is SUSD and I guess Athena's assets at the moment are still pretty small relative to both open interest in centralized exchanges, but then also DeFi itself. So at the moment, we're still sub 2% of TVL on Ethereum. So it's not like a systemic issue at the moment if something were to happen with SUSD. But if you are starting to integrate Athena's assets into different pockets of DeFi and starting to lever it up to positions which get dangerous across the entire system, this is just something that we need to be aware of and actually monitoring collectively to ensure that we're not actually blowing up those bubbles that Rune was alluding to earlier. So one piece that we're just cognizant of at the moment and just encouraging people to consider is that we are obviously increasing risk as you are adding leverage to this. And I'm not here to tell you what to do with your assets. I think that's actually what's so beautiful about DeFi and crypto in general is that you're all adults and you can make your own decisions. And these are permissionless markets. So I don't really have a right to tell you what to do or how to manage your own risk. I think it's just us as a team cautioning users that there are additional risks when you are using leverage. And I think it's not good enough actually for us as a team to just say that these are permissionless markets. You guys go ahead and do whatever you want. We need to be actually conscious around the incentives that we're putting around it to ensure that it's not growing too quickly and too large without due caution being considered. And so I think for that reason, whatever Maker's planning to do in terms of sizing and timing, that's obviously their decision and that's not our decision to make. But we and I guess the core team at Athena will be monitoring this and we will not be adding additional incentives if we do not feel comfortable with the size and speed that this is moving. And so initially we're going to be putting on some pretty strict caps around what that size does look like in terms of additional incentives that might come on top of it. So this is the points or like the shards and sats that people are farming at the moment. And so on the Athena side, we're going to be conscious around that and just making sure that we're doing it in a slow and controlled way so that we're not over incentivizing behavior, which might lead to more important like systemic risk down the road.
Great,
So I
thanks,
just want to
Guy.
add something to that.
Sorry,
I
go
just
on,
wanna-
Rune. Yeah.
Yeah, like because I mean, so of course in general, the point Guy's making, right, which is that gotta be careful, gotta monitor everything that's happening, and also I guess another point of it is, I mean, something that really generally is important to understand, right, is that sort of risk management and like whether it's financial risk management or it's technical risk management or legal risk management, right? All of this is mostly it's a process, or rather, it's really in the process often that the tail risks exist nowadays. So it's quite easy to sort of do an upfront check of something and then have it be sort of good enough, and then you work with it and it doesn't blow up immediately. The real problem is if you're not sort of actively looking for signs of what can go wrong, right? And you're sort of sleeping at the wheel when things start to go sideways, right? And I guess that's sort of common theme of a lot of major financial blowups in TradFi and crypto in general. So I totally agree with that. Yeah, what's also interesting about it is that in crypto sometimes, I mean, because we not really, it's just I guess true for any industry, right? But it's very important to focus on actual risk management, right? Not like performative risk management. So like sometimes, I mean, well, most of the time, the way humans like to act is they like to just, they like to sort of satisfy their emotions, right? So risk management can become more of a question of like making statements and sort of talking about stuff, right? When what really matters is like understanding what are the risks, trying to quantify them, and then act on them rationally, right? Like based on what are the actual issues and how can you actually deal with them. I mean, what we saw in Maker in the past is that there's this tend to like the risk management, the risk mitigation mindset sort of ossifies into a kind of let's put up barriers everywhere and just like make everything difficult because it feels good to make it difficult because it makes us feel like we're mitigating risk. But of course, that's not, like I just said, that's not how it actually works. Anyway, but I mean, I just wanted to generally weigh in on this topic of thinking about risk, right? Because of course it's really important. I mean, the most important thing is actually not even like the first order risk or the second order risk of like fixing the upfront risks or continuously monitoring the risks over time. It's like the sort of the third order risks, like the cultural risks, right? Of like, how do you ensure you do maintain the desire to even care about monitoring the risk over the very long term? And actually, as a side, I also think, like, I think that's why there's such a major reaction to what Maker's doing now, because I think most people that actually look into it, they understand that like the technical and the legal and the financial risks, they are actually being managed with the perp yield, the basis trade, right? And it is like a standard type of exposure that's been going on, and it's a well understood thing. It's not like, it's not like an algo stable coin where it's like some made up thing that no one knows how it works, but they're hoping for the best, right? Like it's pretty easy to actually pick it apart and understand how it works. But I think what people are reacting to is they're worried about whether there's like a cultural risk happening where Maker is gonna sort of shift from being extremely risk averse to actually being like super risk taking over time, right? And I think that's a very valid thing to worry about, and that's generally how I would assess any protocol or any project. But then, I mean, basically, I think what's then important to understand is it ties back to what I talked about earlier of like, there's a very specific moment in time where the risk-adjusted yield is mispriced, and it creates an opportunity to build up these capital buffers for the sub-DAOs. The long-term way that Maker is supposed to function is basically with a call that handles the risk, right? That with a call that only deals with tail risk, and then with sub-DAOs that sort of try to innovate and generate yield and generate growth within the constraints of an overall paradigm that protects against tail risk. So we want to kind of have both, right? We want to have both resilience and growth at the same time by kind of splitting it up and basically doing division of labor, right? To specializing into who generates the growth, who protects the overall resilience of the system. Okay, actually, the reason why I started talking was because I wanted to just mention. So just so you know, I had to say all this stuff about risk because I don't want people to think that we are just like downplaying risks now and we don't care about it anymore in Maker. Like it's really the opposite, right? I mean, it's more like we care about the risks that actually matter more and more, and less about performative risk management, right? So I wanted to point out that the key risk guy mentioned was that he saw, right, is the risk of SUSDE depegging, right? And maybe even USDE depegging or something, like some kind of like irrational price sort of aberration where you have a stable coin suddenly losing its price for like an hour or something, and then going back to the peg, or for a week even, and going back to the peg, right? That can happen with these kind of assets. And that we've seen liquidation cascades in the past in DeFi where this kind of stuff happened. I think with DAI even we've seen that. And I mean, there was the USDC depegging at one point, right? And that probably resulted in some liquidation cascades in places where oracles weren't prepared for this, basically. Or the liquidation mechanisms weren't prepared for this. So as I understand it, I'm actually not 100% sure, but I'm 99% sure this is how it works with the Morpho vaults, right? We've set them up so that there are no oracles actually measuring the market price. of USDE and SUSD. The oracles are just hard coded to basically just like to the kind of the official redemption price of the assets. And this, I mean, this is of course like this is really bad if you worry about a kind of like the classical financial or like volatility risk scenario of like regular crypto CDPs, right? Where if the price of ETH falls close enough to the value of the loan, you want to sell it off before it's too late. And because you can sort of assume that if the price is already falling, then it will tend to fall even more, basically. But that's not really, I mean, it depends on how you approach the stablecoin or approach the asset in your system. But in this case, with USDE and SUSD, the way that these assets fit into the ALM, so the asset liability model in Maker, so the kind of the system that ensures that there's enough USDC available in the PSM to make sure that DAI will trade at $1. So you have this model where you have some assets that are super liquid, like USDC, and then you have other assets that are less liquid, and that could be like treasuries, for instance. And that's where you earn the yield. And then at the like sort of the far end, you can have stuff that is really, really illiquid, like really long-term, like mortgages and that kind of stuff, which actually Maker also has a little bit of due to various experiments in the past. But the vast majority of Maker's assets has been treasuries for a long time, right? And then also crypto vaults, like over-collateralized crypto positions. And basically, that's also the bucket that the basis trade fits into. So it's not like, so these stable coins or whatever we call them, you know, maybe we shouldn't call USD a stablecoin, but these assets are not considered like cash that's supposed to be one-to-one liquid at any point in time. So that's why actually we don't want to have these variable oracles, because we'd much rather like, so if there is some kind of loss of the underlying, there is some kind of issue happening in Athena itself or in the exchanges or in the custodians or whatever, it's much better to resolve that over like, I mean, basically take some time to resolve it and using legal means rather than just trying to fire sell it the moment that there's any indication or even a mistaken assumption that there is some issue with the underlying. So that's how the system is set up now. So that's just, I just want to make sure that people understand that, like, so that this risk of like SUSDE getting depegging or having like price swings and because of people wanting to get out or something like that, that's actually a risk that Maker itself absorbs. And the users levering up, for instance, they actually don't have exposure to this. They can't get liquidated from this. Instead, what could happen, and this is kind of the risk that Maker is taking on, right? What could happen is that Maker runs out of USDC, which is right now set to be 25% of the total DAI supply, right? So if suddenly there's a drawdown of 25% of all DAI in existence, so all the USDC gets taken out through the PSM, then you could have a situation where Maker would need to tap into, I mean, either the treasuries or the perp collateral, or try to do something with the crypto vaults. But basically that is, I mean, that's how the risk works, right? And that's how the asset liability management model works. But also it's like, I mean, it's no different from how it was in the past, right? So the difference is now that likely in the current scenario where there's extremely high yields, all or most of the exposure that's currently in treasuries will just go to the basis trade instead of being in treasuries. And they're not really, like, they're basically from a sort of a duration perspective of like how fast can you turn it into USDC you can have available on chain. They're pretty equivalent. I mean, they have sort of different pros and cons. Ultimately, there's not really a greater risk to DAI liquidity. And in some, I mean, actually in many scenarios, that's actually less, like actually perp like basis trade exposure actually provides much better liquidity. In fact, that's actually what I think is so like the killer app of Athena, really, right? Is that it tokenizes this stuff. So so that if in some freak scenario Maker should need to do it, we would actually be able to go out and sell SUSDE at a like below market price, sort of fire sell it just to prevent a depeg, and then just take a loss and just take a loss to the capital buffers.
Yeah, thanks, Rune. And to kind of keep down this path of risk, obviously, it's kind of the crux of this whole integration and people's concerns. And also, Guy, I know you have some views on, I guess, from a yield perspective, the risk-adjusted yield of this whole opportunity. Obviously, we've got like a risk-free rate of about 4 or 5%, obviously with treasuries now, and we're looking at like funding rates of higher than 30% right now. Could you, I don't know, share some thoughts on the risk-adjusted yield there?
Yeah, I think it's just worth always. We're obviously talking about the risks of Athena's design, and I think that that's something that we should do and talk about in the open. But I do sometimes think that we see apples to oranges comparisons where we don't think about the all-in return. So you've obviously got a spectrum here where if you're holding something that looks like USDC, you are essentially an unsecured creditor to Circle and getting paid 0% interest for that position. And it is not a risk-free position, I think, as we saw. And as Rune pointed out at the beginning of 23, there are definitely custodial risks with all types of fiat stablecoins or RWA-backed assets. And so if you have on one hand an asset that pays you zero, you're an unsecured creditor to Circle, and then you took a haircut of 10%, some people don't think that that's actually a great risk-adjusted reward. While there are financial risks, obviously, with things that Athena's doing, and I think that we've laid them out in our documentation if no one has had a chance to actually go and look at that. I think you do actually need to contextualize the risks relative to the return. So I think part of the thesis and why we thought Athena was an interesting opportunity was that we personally do not think that an unlevered cash and carry should be paying you more than 15, 20, 25, 30%. We think that rate should be closer to 10 or some small spread to RWAs. And that's actually the opportunity, which is there's an inefficiency in the market. We think that is a super normal return to be able to capture relative to the risk. And so if you do see small issues on the margin, whether that's issues around liquidity, whether it's issues around funding rates, you can really try and actually box up these risks into an outcome or like a potential loss that can occur, and actually just size up what do you think that risk actually looks like. And when we've done that on our side, and this is obviously just our own views, you should obviously take these views yourself, is that these are small potential issues where you might see a point or 2 points of haircut to the principal in a really downside scenario. And so you've really got to contextualize that relative to the return, which is if you've been sitting in SUSDE and that's been paying you north of 30% for the last few months, and if there's a disaster at the end and you take a point of a haircut at the end, that obviously just needs to be contextualized relative to the actual return that you've accrued through that period of time. I think that actually also extends to the way that Maker is actually structured what they're doing at the moment, which you can really think about it as a Maker is kind of farming Athena right now with extra steps. And if you actually look, I think, at the position that they've taken, right now, I think that they have the most attractive position of anyone who's sort of participating within Athena. So they're earning, I think the last numbers I saw, and this is on the weekend, so it might have been updated, was roughly 40-ish% on $100 million for a weighted average LTV in the high 80s. So I think it was around 86%. So you're over-collateralized not only to USDE, but then also to the insurance fund that we have within Athena, and you're getting paid 40% for that position, which right now is actually above the basis within the futures markets. And so that position is actually, like, on a risk-adjusted basis, like, over-collateralized, earning what I think is a pretty incredible spread. And I think it's getting to the point that Rune was making, which is we can't just be doing these comparisons, thinking about something that is paying you either 0 or 5%. It actually has to be contextualized relative to the return that they're making. So I think in the current construct at the moment, who is actually the big winner out of everything that's going on? It's not even us at Athena. I think that the structure that Maker has in place right now is potentially the most interesting piece of the capital structure at the moment relative to where the yields and the risk actually sit.
And Guy, I guess some of the concerns raised about the whole integration, obviously specific to Athena, we've kind of addressed them before and they're addressed in our documents, but maybe at a very high level, it'd be useful maybe to go over, just for users that haven't heard us talk about it, maybe some of the concerns around LST stability specifically, custodial risk, and then maybe yield sustainability. I know if that's probably a lot to touch on, but if you want to just take even one of those and just talk about it at a high level quickly, just because obviously that was one of the concerns raised by people in governance forums and on Twitter as well.
Yeah, sure. So I think we've seen quite a bit of commentary around the potential like liquidity issues that you might face with LSTs in general. This is actually a topic that I have personally begun to change my own mind on, and it's something that I'm actually going to be raising with everyone, I think, at the beginning of next week in a bit more of a longer form discussion around risk and like the go forward path for Athena. Just to give everyone like the context of how we were thinking about this product when we were actually designing it in the beginning. This is at the beginning of 2023 when stETH yields were around 6%, and the basis for shorting ETH perhaps was roughly in the order of, call it 6 to 10%. So you're roughly getting paid like equal yields on either side of that that transaction, and it sort of made sense that you're capturing yield or at least a positive carry on both the spot leg and then the hedge position as well. I think what we've seen as like the bull market's evolved is actually that market dynamics have changed quite a bit. Not only as a result, I think, of Eigenlayer and then just general increases in the level of staked ETH and like the resultant impact that actually has on staked ETH returns. We've obviously seen those yields compress from above 5 to where they're sitting now between 3.5 to 4%. Equally, on the other side, obviously, as a bull market sort of progresses, the basis for shorting ETH perhaps has got pretty wild, as everyone's noticed. So it's been roughly averaging around 35% since the beginning of this year. And so really, like the maths there has changed considerably, where the yield on the collateral has almost halved, while the yield on the short leg has pretty much 5x'd since where it was when we designed the product originally. And so I think the risk that everyone's pointing out around LST liquidity and duration profiles is actually a really valid risk, which is there might be a liquidity crunch when everyone's wanting to get out, and there could be an unstaking queue to redeem your stETH for ETH, or there might not be sufficient liquidity to turn stETH into dollars and return it to people who are redeeming. And that is actually inherent to the reason that you're actually getting paid a yield to hold staked ETH. So I think a lot of people conflate stETH being equal to ETH, and they are absolutely not the same assets. There are different risk profiles embedded in them, and that's actually why you see a different return. And so I think you've actually seen that within Athena when we first came out, and this is when we're sub $100 million in terms of supply. The ratio of like stETH to ETH was roughly 80% of like liquid staking tokens, and that percentage has actually fallen dramatically to sub 20% at the moment. And so the total sort of backing sitting behind USD at the moment, and this is obviously about to change with the BTC that's coming through at the moment, is actually shifting to a much lower exposure to these LSTs. And that is, I think, part of us just recognizing that I think the liquidity and duration profile of staked ETH and the current sort of like returns makes a little bit less sense than where it was before. That doesn't mean that we're going to be not using any LSTs at all. This is something I'm just wanting to take to the community at the beginning of next week, which is if there are a lot of user concerns around this specific risk point, and we don't feel like at this point in the market cycle, it actually is an adequate sort of return for the risk that it is embedding into the product. I think that is something that we're open to sort of reconsidering and just thinking about how that sort of fits into the product design going forward.
And Rune, maybe to follow up on that point, I guess there's a similar approach in terms of adjusting the kind of the backing assets or the maker balance sheet through bull and bear cycles now, maybe with obviously a lower allocation to RWAs. Is that something that's that kind of a trend you think that we'll see continue now, is maybe taking more advantage of yield opportunities in a bull market and maybe moving towards safer allocations in a bear?
Yeah, I mean, so what we've really hoped to achieve is that we can automate all of that with the sub-DAOs, right? So, right, I mean, so basically the way it's supposed to work is you have the core system, Maker Core, which is this very, so in Endgame, which we'll begin getting towards this state already this summer, right? And what the core does is it sort of regulates the ecosystem and regulates like how users and how sub-DAOs can generate the stablecoin. But the actual generation and the actual putting stablecoins into circulation, that's all done by the sub-DAOs within these rule sets created by the core. And then it actually, yeah, it works. I mean, one analogy is to think of Maker as a central bank and the sub-DAOs as commercial banks. But of course, it's an imperfect analogy because there's also, like, the sub-DAOs, first of all, also can do all sorts of other random things like gaming. And then additionally, there's also a lot of things that banks do and central banks do that Maker and the sub-DAOs don't do. But ultimately, it is really that that Maker kind of tries to create the best possible general rules of saying these are the boxes, these are the rule sets for how we are trying to avoid tail risks. So that could be something like saying, well, if you want exposure to, and then and the goal is to sort of make it as much as possible about we're trying to mitigate risk this way, not you have to do X, Y, C in these following very specific steps, right? So try to leave the kind of the landscape as open as possible for experiments and innovation and competition between the sub-DAOs, but making sure that the risk is mitigated. So one example could be how to regulate exposure to the to like the ETH and Bitcoin basis trade with assets held in custodians and then then open short positions on exchanges, right? And then the core DAO could enforce a rule that goes something like, however you get this exposure, you have to have 10% over collateralization or junior capital, you could say, right? You have to have 10% sort of capital that takes the first loss before you take the loss, right? Before the sub-DAO starts taking the loss itself. And the sub-DAOs could then achieve this in all sorts of different ways. So one way to do it is with the Morpho vaults, right? And that's also why we created the Morpho vaults. So that's why we and sort of set them up to be owned by Spark, right? Because this would actually be a way for Spark to sort of naturally move into this kind of framework where there are just certain requirements for how they're allowed to take this kind of exposure. But a different way to do it could actually be that the sub-DAO just basically puts up its own collateral, like puts up its own junior capital, right? And then basically sort of segregates and isolates some junior capital and says this junior capital in the pile over here specifically, is the over collateralization for this exposure position in a different smart contract that the sub-DAO controls, right? And this is an extremely flexible approach. And the technical kind of the technical component of this approach is what we call the allocation system. And so the allocation system is kind of like like a DDM, which is a very crude mechanism that's set up right now to funnel assets into the Morpho vaults. And there's also the mechanism we use to allocate assets into Spark. And was originally developed for putting assets into Aave in the first place, but it's not really been used much, and it's just that it's kind of it has this problem that it's fundamentally built on the legacy vault engine in Maker, right? So the native vault engine with the old Maker vaults before Spark, which is just it's a very robust system, but it has a lot of design decisions that makes it just more difficult to work with. And then it becomes unsafe or just unworkable to try to scale this up and actually fit it into this kind of flexible approach that we're talking about here, where sub-DAOs can actually, as long as they put up the collateral, they can go and take, they can sort of choose what kind of risk they want to take. Also as long as it conforms to the risk. Basically the requirements, the risk requirements for each type of exposure. So basically, the idea is you can just then put in place these requirements, have the system, have the mechanism for monitoring how the system is set up, and then have enforcement. So basically, how to take control of a sub-DAO if it starts breaking the rules, right? And how to react to that, and how to intervene before it takes an action that's as against. I mean, it could be something that's actually like technically allowed, but it's against the spirit of the risk management framework, right? So you have to be ready for all of those types of edge cases in this sort of situation, because obviously the sub-DAOs, their job will be to push the risk, right? Push the yield, and try to be competitive on that front. So the core has to be the one that guards the tail risk, right? And can step in very decisively if there's any kind of misalignment happening. But with all of these components coming together, then what happens is you have an environment where basically whatever market cycle is happening, whatever market opportunities exist, whatever like new market distortions or upcoming risks that are on the horizon, all of this stuff, the sub-DAOs should be fully equipped and incentivized to follow all of these, like to basically to like react to all of these trends and try to take the best possible position, and even do things like compete with each other or learn from each other or copy each other. And ultimately, this all happens within the confines of a system with these very heavy guardrails, right? Where ultimately, I mean, again, kind of like how central banks try to regulate commercial banks, and then fail for various reasons sometimes, right? Which I would say is mostly cultural at the core. It's like a cultural problem, and that's, but it's a system similar to that we're trying to build, right? But just in the DeFi world, and the end goal should be that it is capable of producing like a better risk-adjusted yield than, well, at least, I mean, the best possible risk-adjusted yield that you can achieve with open data and open machine learning models and sort of like what's kind of available in the free market, basically.
Thanks, Rune. Yeah, obviously heard you talk about sub-DAOs for a long time, and it's super interesting to see them actually at work now. And yeah, really looking forward to seeing how that plays out. All right, so I might open the floor up to Q&A. Obviously, I see Mark from Aave is up here as a speaker. Mark, if you're there, believe you have some conflicting views as to or skeptical views as to this integration. Maybe it'd be useful to hear a quick word from yourself. Obviously, just try and keep it civil, but I don't know if you had any thoughts or concerns on the integration that maybe we can
civil.
address.
I'm Frenchman. I will do whatever I can, you know. I mean, it was quite an interesting call. Not too much bullshit. Sometimes a bit long, but quite interesting. And I'm glad that you have participated in this one. So if you guys want to have a discussion, I'm more than happy to have like some kind of balanced opinion about what has been said.
Yeah, we can definitely set up another spaces if everyone wants to do another one. I need to jump in 20 minutes, but if even later today, if you want to find like another hour, more than happy to have another one for more balance here.
Yeah, well, one thing I want to say about like this whole stuff, that I have the belief that the eternal risk is overstated right now in the ecosystem. The only concern that we have, and maybe it's not something that has been well understood over the past few hours or past few days, is not really the ETNA system in itself. We think that's a clever system, and we do believe that's something that already exists since quite a lot of time in traditional finance and even in crypto. So there's no reason it doesn't work. The only concern that we have is the speed of growth. So basically, our job, compared to other protocols that just don't care about their user and the risk management and their user deposits, our job is to make sure that when people deposit assets into Aave, they have a legitimate expectation that they can remove the same amount of money plus the interest that they collected. And in order to do that, it's really important to assess what the risk they are exposed to and to react to that. And the speed of growth of some credit line is concerning because a good system, badly sized, can become a dangerous system. And that's basically our reaction of what happened is that basically in 3 weeks, Rune decided to mint 600 million DAIs out of nowhere and just take a trade with you guys, which is fine in itself, but it's quite annoying to us because we don't have a visibility that if this dictator is stay benevolent or not in the future. Because if he tried to do that with $3 billion, we might have a problem in the future, and that will impact the other users. So that's basically our situation right now. Like the smart contract code of Morpho is fine. Like as Paul said, it's 600 line of code, and even them are not stupid enough to fuck up 600 line of code, and they have like some good audits on that. But the thing is that this protocol is extremely weak about economic attack and risk mitigation because they are not decided to focus on this. And high deleverage situation like we've seen on the past cycle. I want to remind everybody that during the life cycle, we've seen on Aave in less than 3 weeks, $6 billion of liquidation happening. It can get ugly very fast, especially when you decide to outguard the price feed of your vote to say, okay, one DAI is one SUSD, and that's how it works. And that can lead to ugly situation.
Okay, so let me respond to that because I feel like you made 2 points, right? So the first point is that it's like sort of I would describe this as like the cultural risk or the governance risk in Maker, that there's this sense that the governance processes of Maker itself can just become irrational and take irrational actions.
Basically, there's no more guardrails. So it used to be a DAO and a huge source of inspiration, especially for me when I created the ACI. And basically, in 3 weeks, you decide to mint $600 million. Would you agree that's a bit radical and unprecedented in the MakerDAO history?
Yes, but and then the other thing you talked about was just the price feeds of the Morpho vault. So I'll try to reiterate that and the ALM point. But so let me just clarify, right? So what I did was I made like basically a proposal for what's called a bootstrapping edit to the atlas. So that's like the core rule set that Maker uses to sort of set all the different parameters, like set all the different governance processes and rules and parameters and so on. And then as a part of that co-edit, it gave the stability facilitator, and which is kind of our, let's affectionately call them bureaucrats, right? But the sort of the functions in the DAO that control the different, like that sort of have the more day-to-day control over how the governance processes work. And what this edit to the atlas did that opened up for the possibility of adding the basis trade, and then also like it more directly set new parameters for how the smart bird engine works, right? But what the edit did was it allowed the stability facilitator to propose new vaults that takes the basis trade based on input from the risk advisors in the system, like in the DAO, right? Which and so I mean, what I really want to refer to is the risk assessment that was posted by BA Labs, right? That basically, like the 600 million number is not enough. Like I didn't pick out that number, right? It's not like a hard-coded number. There wasn't like a governance proposal with a bunch of NPR voting for some, here, let's do some like random arbitrary allocation of some random amount.
What you did
It's-
is to extend 1 billion DAI to the Spark DAI Vault credit line. Is that correct or not? Because you can say it's
No,
not
that's
correct. I have
incorrect.
the figure under my
Yeah.
eyes, so I can share that to the internet. So just say it's correct.
It's incorrect. So what the risk team did is they made an assessment, and on the basis of that assessment, they proposed parameters for what's called the instant access module, which is the kind of the guardrails for how something like a DDM works. But it's also
What's
how
the guardrail? Like this proposal has 9 answers of it, and all of them are just you guys. And maybe you can say that there's some form of dissent with period, which is GFX Labs on your forum. But there's basically zero debate. Like compare any proposal that exists right now in MakerDAO and the proposal that happened in Harvey. Like there's no discussion anymore, guys. You just do whatever you want. That's the point. That's the point that is concerning, because it's hard to predict.
Well, I don't know. I think like having randos make decisions is just as unpredictable. I mean, it's not important who or how a decision is made. It's what decision is made that's important, right? So, I mean, of course, I get that. I'm sympathetic to like obviously, the who or how can be a big input to the what, right? But it can also cause a lot of damage, and that's kind of that's the problem we've had in the past with Maker, where we had these like basically kind of hidden run proposals for everything, right? That we've moved away from, and this is why we now have the Atlas structure. That's it's like a much more structured, much more focused approach, where you kind of try to encourage new proposals and new modifications to governance to build on top of the existing ones, instead of just everything being kind of like a what we used to see with hit and run proposals, right? Which could sort of be like random proposals for anything kind of random, right? But and the point I'm making with this is that when you're trying to decide on risk parameters, then I mean the people you should be listening to are the risk advisors, right? And the experts in this area, right? That's how you should decide your risk parameters. And of course, that doesn't mean that BA Labs, they're the only ones in the whole world who can produce risk parameters. And whatever they say is exactly the word of God, right? But certainly, I mean, it only makes sense to listen to anyone that actually comes with a real risk assessment, right? And then you can say, well, BA Labs, they're the only ones we're paying right now to do these kind of risk assessments, which is also true. And of course, we're interested in hiring more and finding the right talent and so on. But one thing I've learned for sure is that it's net negative value to, let's say, hire someone inferior just for the sake of theatrics, basically, or even worse, having like randos actually make an impact on how decisions are made, right? And also, I mean, the implication of arguing that random people should get to set parameters, that then also just naturally kind of leads back to then the idea that someone like me should be, that leads to this thinking of like, I made up the 600 million number because of course it's just a random person that made this stuff up, and there's no actual thinking behind it, right? Like the reality is that the number isn't made up. It comes from an actual risk assessment, right? And I mean, I keep seeing all this. I mean, there's all this like emotional outbursts. There's all these like complaints, and I understand. I mean, in the end, I think it is again. I mean, it's related to this like perceived cultural risk, which I think is valid, right? That it is something to watch out for, right? Again, I mean, we're trying to solve all that with Endgame, right? And segregating the risk between sub-DAOs and the core DAO and so on, which is why it all ends up playing into why we need to take some bold moves at this stage, right? Because it really gives us the opportunity to make the sub-DAOs much more effective. But no, the point I'm making is that, I mean, everybody wants to talk about the risks, right? or the sort of the second, or like the risk of the risks or something, but no one actually gets into the meat of the actual argument and like explains why it's like, right, it's
Yeah, but the thing is that at Aave we are data oriented, and the thing is that it's unprecedented because the protocol that is hosting has been dubbed enough to host you and externalize your risk has no market data for that kind of size. You basically alone are becoming like 80% of their TVL. So the thing is that there's simply no market data, no historical data to how this market will behave at that size. And you guys are minting, like you gave LLTV of 94.5% on 10 million DAI, on 30 million DAI for 91.4% LLTV for SUSDE. And the thing is that it works. That parameters means it's 15x leverage, it's 20x leverage. How do you deleverage that is completely an unknown in an untested and parameters. Even doing that in Aave is not something that is that safe in the sense that we don't have this kind of deleverage every day. But doing that in a protocol that nobody has tried in the past, that's the definition of reckless to us.
Yeah, okay,
Mark,
this
can you
is-
elaborate on could you elaborate on those risks? Like, what difference would it make on Morphoblue versus on Aave, and considering the caps, you mentioned one,
Because you
50x
never
leverage
and
and
never
20x
fucking
leverage.
liquidate a position in your life. Your protocol is 6 months old. What the fuck are you talking about?
Can you make like objective arguments? Like, can you
That's
just
an objective
walk
argument, not that
Can you-
tested. That's real modeling
Can you
involved.
walk us through like
Okay.
Can you walk us through like the accurate argument of like what that would be, different? And
Because-
to be frank, I'm super happy to hear it. Just like
do
make
you
the word
understand
point. Right?
what 20x leverage mean?
Yes, I
and
do.
do
And
you
I also
understand
understand what a cap
what
is. I also understand
deleverage
what
of
a
the
cap
guys,
is.
20x position is?
guys, let me try. Okay, so I'll because I mean, there's multiple points being made. I think we're reaching the limit of how constructively we can continue this conversation, right? But I want to I think the key point, as I understood it now, right, that Mark is talking about here, is not so much like it's not that there's like technical risk and Morpho's suddenly going to randomly blow up, like this kind of like it gets hacked, and that's not I think generally there's a clear understanding that it's safe in that sense, right? Then in general, so this is both generally for the basis trade exposure in general, and then also specifically for over collateralized CDPs, there is this kind of funky sort of like confusion around how does duration risk work for this stuff, right? So Guy was talking about this earlier, that SUSD can depeg, right? Like if everybody wants to get out of SUSD all at once, then you can't necessarily all exit all at the same time.
That's not the main risk, Rudy. In this
No, but
situation, that's not the main risk, because you have got the price.
But let me just give me a moment to go through, right? That's the point. Is that's one side of like the kind of the duration risk, right? So the second issue is the kind of the CDP duration risk. So basically that today, I mean, when we try to, like if we run out of, this actually happened, right? So this actually sort of set off, I don't know, the current season of DeFi being more crazy than it usually is, right? Is when makers started to actually run out of USDC, right? And then we had to dramatically increase the rates. And this is an example of, I mean, I think this is what you're referring to, right, Mark? So like, it's an example of like, you can't just take the collateral in a vault and then go and sell it on behalf of the user. The same way you can take, if you have an RWA setup that gives you exposure to treasuries, you can take those treasuries and you can sell them instantly. And then you can take the money and you can convert it to USDC and you can send it into the PSM. So Morpho kind of like has the kind of exposure, the kind of setup we have now with the Morpho vaults gives some kind of strange mix of the two risks, where like And so it can be really hard to like understand like what exactly does that risk look like, right? So it's like you've got the liquidity risk of the Athena tokens themselves, and then you've got the kind of the vault CDP risk of the fact that it's exposure not directly to the asset but to over collateralized positions of the asset. And I mean, I would basically say that like the actual risk is kind of a mix of the both, because it's not like you take the worst of the Athena liquidity risk and then you mix it with the worst of the vault liquidity risk. It's more like you get some of the downside of both, and you also kind of alleviate some of the issues of both, right? So, I mean, the way you delever vault is you increase the rates. That's like the only way, right? So that's how you like. I mean, in practice, you'd pull out the kind of the free DAI that's supplied from the Waffle vaults, and then what will happen is, well, I guess currently it's like the cookie cutter like rate formula, I believe, that exists in Morpho, where it's like basically when there's more than 90% of all assets have been borrowed, like all the loan assets, I think it's called, when more than 90% of them have been borrowed, then the rates start to go up. And then you're supposed to then the way that deleveraging occurs is you hit the so-called pain threshold, right? You hit the point where at some point the rate to borrow gets so high that people start closing their positions. The problem is like this there's all sorts of like behavioral issues here, right? Like, so you can't people aren't like robots that are going to be monitoring their pain threshold in real time. And you have all sorts of issues like that. So like naturally this doesn't mean you can just set again, this doesn't translate directly to.
That's a lot of work, but we experience actually on that. So basically, we had an asset called BUSD on AVB2, and we had to offboard it because of the Paxos situation and the fact that BUSD will not be redeemable at some point. So we did exactly that, like introduce new interest rate strategy to introduce a pain point and force people to actually repay their position or basically get liquidity, because at Aave we have this ability to allow, when specific things are in place, to repay that debt on behalf of any users in exchange of part of the collateral plus a liquidation bonus. That's the same thing on your system, and that's allow the Aave user to be safe. What we learned from the data is that because we increased the reserve factor collection and the fee collected by the protocol, we had the budget to make sure to clear the excess debt of people that just let the position die. And that's basically what could happen, is that if at some point the trade is not interesting anymore and you have very high leverage, you will have a reversion of the yield curve and your position will start losing money fast. And some people will not react, and you will end up with under-collateralized position. But the thing is that there's no safety module in Morpho. There's no liquidation when the price feed happens, or at least no experience of large liquidation. So when you have the cost of your debt increases much faster than the revenue of your collateral, you will end up with an under-collateralized position. And what happened at that point is a clear unknown, because we don't have market data showing what will happen at that point.
So Mark, can we come back on this very quickly, because I think there's a lot of like misunderstanding on how Morpho works compared to Aave. So first, I think it's worth saying that every single market is isolated, right? So a market with a given risk does not contaminate other markets that are completely unrelated to others, like on Aave. So if something bad happens on a market on Aave, it can impact other markets up to the cap that is set by governance. This is not the case on Morpho, right? And so the reason why, like on Morpho, there is the concept that, bad debt is realized. So whenever like a liquidation happens and made a position, be under collateralized and is leading to bad debt, then bad debt is realized and lenders are taking loss. So it's like a very different paradigm than what you have on Aave, where, the Aave
in this
platform
case, the LP is the MakerDAO protocol. So basically, the bad debt is realized, and you mean it die, and you cannot realize that debt and recoup that debt. So that DAI is burned or locked.
Yes, you can. Of course, you can. Why can't you? Why can't you? Can you explain?
Well, can I try to
if the position is under collateralized, that mean that the DAI itself is under-collateralized in that position.
No,
It's not like
So let me
what
try.
you want.
Yeah,
DAI.
let me
Yeah,
try
go-
to
go
walk
ahead,
through how, because I think I understand, like, right, you're talking about the scenario of like the Athena underlying collateral is producing a negative yield, and then we want to deleverage fast, and then what's happening is just like we can't force the users to exit their, like, what we actually want is we want the users to go and take their take their SUSD and take it to Athena and like redeem it. So we want to unwind. Like, what's happening is we've got this massive exposure on the perp exchanges. It's producing negative yield. This makes no sense. It should be unwound. We want to get the users to do that, but no matter how much we increase the rates, they don't do it. They're like, they're asleep or whatever, right? So we're increasing rates. We're far past the pain threshold, right? They're earning less on the collateral. They're paying much more debt, but they're still not going to redeem the collateral. And then this is kind of like, now you've got sort of a race against time, because you do have some time, right? And the reason why you have some time is because of the over-collateralization. So like, even when the Athena collateral is producing negative yields and you're losing money from holding it, the DAI that's been lent out for that leverage still hasn't been used up. Of course, like, you don't have infinite time, because the leverage is really high, right? The leverage is, compared to normal crypto assets, leverage is 10x. Which is actually, I think that's actually quite low for this risk. So it's set very conservatively but then to make sure that this situation can be very confidently managed, right? But basically, so the exact mechanics of what then happens, right, is what really happens, because especially because the oracles are hard coded. So the market is sort of even simpler than normal, in that, like, you don't even have like an oracle effect triggering liquidations. You only have like liquidations occurring when debt grows to be as high as the official value of the collateral. But then, so what happens is, if like Maker wants to fully unwind the exposure to zero, meaning the utilization in the vault is always at 100%. Then, basically the rates go to infinity eventually, right? So they sort of exponentially grow. And then what's going to happen is, like, every single position gets liquidated eventually, right? But yeah, I don't know exactly how.
Yeah, so no, that's exactly what's going to happen. Like, interest rates starts piling up until positions get liquidatable, and then liquidation happens. Some liquidation will generate some bad debt, and this is where Maker could take a loss from the higher loan to values positions, and that's why there is a cap, and the cap has been set, thinking about secondary liquidity and how much liquidators are able to liquidate for a given loan to value, right? And you can see more of the work that has been done by Block Analytica and like the forum around like computing those caps and risk parameters. And and to be frank, even with this, like I still don't understand your point, Mark. I have to jump in a minute for a call, but I don't see in what way this is a problem.
So
I know, because you don't have experience in that. I know you don't see.
But can you make actual scientific points on this? Like, can you actually explain what's deep into the weeds? Like, what's going to be the problem?
My job is not to do yours, Paul. We have 4 years of market data to back my words here. And if you are not good enough to
please
see what works in the past in our industry, I'm sorry for you.
Let me just try to explain.
The only thing is that you have 70 million DAI. Like right now, I'm on the website. Like there's 10 million DAI right now, leverage 20x, a bit below than 20x, but around 20x, and 70 million DAI leverage up to 10x. And the reality is that if you want to liquidate those positions, the buffer between the collateral value and the debt value is not that high. And if you have a reversal of the rates of the cost of the debt compared to the revenue of the collateral, the liquidator need to act fast. And given specific market condition, like a very high gas price or liquidator that don't show up, and you saw that in the past. That was
of course, and this is why you have caps, and this is why you have different liquidation LTVs, right? I'm sorry, I have to jump, guys. Yeah, sorry, go ahead, Rudy.
All right, see you, Paul. All right.
My point is that on 100 million,
Look,
that's probably
want to-
fine. On 600 million, probably okay. On 3 billion, it will not work, and that's for
So-
sure. And that's gonna hurt MakerDAO very bad.
Yeah, well, I mean that all depends on me. You have to basically do the math, right? But like, I just want to try to like, because we can actually concretely like sort of talk about what exactly happens in this situation, right? So what's happening, you know, so if there's negative yield on the underlying collateral, right? Let's say there's an there's an extreme negative yield. There's a minus 52% ARR on holding a short, right? What that means is now you're losing 1% of your position per week. But it takes a week to redeem, like to sort of unstake SUSDE. Then there's there's always a spread on like doing the actual redemption. So like the actual like closing the perp position and then trading the ETH collateral or the BTC collateral or staked ETH, whatever collateral for stable coins. But let's say even if we put that total loss to, let's say, 2% in an extreme scenario, or even more. I mean, let's say we put it at 5%. So currently it's like 0.1%. But I think in extreme scenarios, it will certainly get you will get more slippage. But again, but the thing is that like this kind of slippage component, what's also important to understand about that is that it's like very like sort of moment to moment. Like it's like if everybody's trying to exit at the same day, then you can get really bad slippage. You can get sort of those kind of like freak scenarios where stable coins can depeg really significantly. But if it's like you're talking about an order of weeks, which is what you're talking about, even if you have minus 52% in funding, and that's consistently remains in place for several months, right? You basically still have more than a month to unwind a 20x position and find a moment in time where you don't have this kind of extreme congestion and you have to take a major slippage on the underlying collateral. And then even if you do have to take the major slippage, right? So even in the end, if you like, it really gets like it goes too wild and there's way too much money put into it, and there's simply no way to escape without taking taking a haircut. Then ultimately you still have all the other capital buffers being in place, right? So that's why currently it would just mean Maker would take a loss in the capital buffer, right? Then in the future, the point is, of course, that this would be the sub-DAO. So you'd have the sub-DAO would first have to use its capital buffer. Then the sub-DAO would have to use its sub-DAO tokens, and then would basically have to die and lose all value and trying to eat the loss. And then the loss would go onto Maker. Then Maker would have to eat into the surplus buffer, which is currently at like 60 million. And then finally you'd start diluting the MKR token, right, or the future new governance token, which is where all this like protocol-owned liquidity comes in and is really valuable, right? That currently there's about 75 million in cash sitting on chain to buy the MKR token if it gets diluted. So like that's the kind of, and that's ultimately where the whole kind of risk assessment has to be based on, right? All of these like scenarios. And ultimately I think basically the basic point that's being made, as I keep coming back to, is that like what people are worried about is general like a risk of a cultural shift in DeFi, where I guess Maker gets too like stops thinking about risk rationally, and then maybe that even sets the trend for the whole space or something, and then we all blow up in this bull market. And that's definitely like that is something we have to make sure we don't allow to happen. But the way you practically deal with that, the way you create a culture where risks are calculated and you don't just YOLO into stuff without understanding it, that is where you have to try to be very specific about like understanding these things and trying to explain them and trying to put it in plain terms, like how does it actually work, right? What are the ways it can go wrong? And I definitely think ultimately I guess Maker wasn't as performative about this as we've been in the past with like sort of there hasn't been as many forum posts, so usually there would be more forum posts and sort of more process. But again, like I said earlier, ultimately the parameters and the way that the exposure is set up is ultimately based on like a really basic process of having the general intention to take some sort of exposure to this, and then a proper risk assessment being sort of the basis for the parameters, right? So I hope that clarifies like how the kind of and the last one I want to make is like I just don't think this liquidity risk is not at all for me like the thing I'm worried about. Like, I mean, sort of like when Guy was talking about Athena, he was like, I'm not worried about our risk. I'm worried about like something happening out in Morpho or something, right? Like for us, like I think the biggest thing we're worried about is like the kind of weird tail, like legal tail risk somewhere in the Athena structure or something like that. But to be honest, it's like it is. I mean, I can't say it's impossible or like, but basically, this kind of risk exists in all RWA structures. So like, it's not unique to the Athena exposure, and if that's the risk that I'm most worried about, and we're like, I mean, someone like an MKR holder like me that would have to take the ultimate loss, right? Then I would of course much rather that we generate as much yield as possible if we're taking the same risk anyway, of some freak kind of legal exposure of some like unprecedented, unanticipated.
I think it makes no sense to discuss factories that have like 0.01% chance of realizing, because if it happens, we fucked anyway. And I think like the main concern for me are not the smart contract risk in this position, because the smart contracts are dumb and simple, and not the Ethena risk, because the way they design things is good. The only thing is that I think those deleverage risks have been understated for now, or at least their consequence have been understated at larger scale. We all agree that on $100 million position and credit line, the risk is quite low, no matter what's the market condition where it happens. On 600 millions, it becomes something that is on the radar, and our concern, and I started with this, and maybe it's a good time to stop with this because it was a very long space, is that the difference between this 100 million credit line and this 600 million credit line is literally like 15 days or 20 days between the discussion of that and the realization of that, and maybe even less than that. And that's what is concerning to us, because this industry and this ecosystem is an ecosystem, so in the sense that we all rely on each other, and we all have to do our risk assessment considering what the other protocols are doing. And it's important for us to consider that MakerDAO is predictable, conservative, and not doing crazy stuff risk-wise, just like they did for the past 5 years.
Right, guys,
I want to make one last.
Go ahead, Rune.
Yeah, I also got to run, but I just want to make one really important point, right? So we're not setting up a DDM that deposits 600 million into to Morpho. What's being set up is a system that basically allows the facilitators, based on the input from the stability advisors, so BA Labs and others, to control the exposure up to that range, right? So it's like a guardrail that says the facilitators can manage this exposure from 0 to 600 million. So I just want to make so it's not that 3 weeks have passed and now 600 million will be transferred across. It's more like now a process can begin where there can be
Analytica post detailing everything that you are saying is from the 1st of April, so literally 3 days ago. Okay. Do you understand our point of view?
Yeah, but I just want to make clear that this is not that, the coming vote, once this is set in place, doesn't result in a transfer of 600 million. It results in the ability to do that based on basically do that in a gradual process, right? That will then be based on, based on monitoring, based on like looking at the data, but it's not like
I have the feeling my argument doesn't pass, so I will try last time, and then I respect your time, and we can move forward to other things in our day. The difference between the publication of the post on your forum is the 1st of April. Today it's the 3rd of April, and 11 hours ago, so less than 2 days of our publication, we have on the forum the ecosystem team, ACT team, as the stability scope facilitator, approve this to move forward. That's basically how it works. Like 48 hours, you publish something on the forum, and then you move forward with a vote. And that's concerning for us. And if you don't realize how it can be concerning for us in the sense that it's hard to predict what MakerDAO will do next, it's something that maybe people that listen to us understand why it's concerning in terms of risk management.
Yeah, I mean, I guess what I can respond to that, and then I think I agree. This space has gone up long enough, and we've definitely covered a lot of stuff, right? But so the response I want to say is like, I think basically I wish we had been able to do it faster, right? So we could have seen it earlier. We could have predicted that this is a massive mispriced asset basically in the ecosystem, and it fits really well into especially in the sub-DAO model. Then we would have been able to really slowly build up exposure sort of far out on the horizon, and that would have been much better. I mean, obviously it's much better to set this kind of rails up when the funding rates are low, so you're ready to jump on it when they go high. But basically, I mean, yeah, we talked about the opportunity, the whole space, right? I mean, every week is a lot of money. It's a lot of assets that can go to building up liquidity or building up capital buffers. So that's, I mean, that doesn't make it better that it happened really fast. Of course, you always want things to move more slowly. That's just to give you an understanding of why it happened fast, right? That it's not like we will this would not I don't think it makes sense to extrapolate from this and then assume that Maker will or sub-DAOs will jump really fast to do very irrational moves, right? It has to be sort of really staring you in the face opportunities like this for it to make sense to basically try to move the governance process really fast.
Right. Yeah, I think we'll probably leave it there. Some great discussion all around. I think everyone will agree that was a pretty engaging discussion. I think we kept it kind of civil for the most part, but yeah, just want to say thanks again to all the speakers. There might even be appetite for another discussion like this in the near future, so that's definitely something we'll try and explore. But yeah, thanks everyone for tuning in. It was a great discussion, and yeah, have a good day.
Thanks everyone.